UnitedHealth has had a pretty strong comeback lately. After a rough and volatile stretch, the stock has bounced back. A lot of that move has been driven by better earnings, improved expectations around Medicare Advantage, ongoing buybacks, and less fear around Trump RX being a major disruption. But there's another headline I want to cover in this video. Berkshire Hathaway recently disclosed that it sold a number of its smaller stock positions, and UnitedHealth was one of them. At the same time, Berkshire also revealed a new $2.65 billion investment in Delta Airlines and a small stake in Macy's. It also exited big positions in Visa and MasterCard along with a large stake in Aon. So this was not just a UnitedHealth specific move, it looks more like a broader portfolio reshuffle. And that reshuffle comes after some pretty big changes. This was the first quarter since Greg Abel became CEO, and it was also the first full quarter after Todd Combs left Berkshire to join JP Morgan Chase and lead a new investment initiative. Berkshire selling is worth noting because anything Berkshire does gets attention. But based on the bigger picture, this looks more like a cleanup or reallocation across the portfolio than a direct red flag on UnitedHealth itself. It does add a little caution. When a major investor exits a stock, especially after a rally, it can cool off sentiment. But let's look at the actual business. UnitedHealth's latest quarter was really good. Revenue came in at about $111.7 billion, which beat expectations and was up around 2% from last year. Adjusted earnings per share came in at $7.23, also ahead of estimates. But the number I really care about is the medical cost ratio. That improved to 83.9%, which helped calm some fears that higher medical costs would keep eating into margins. Management also raised its full-year earnings guidance to more than $18.25 per share. On top of that, the company confirmed more than $2 billion in expected second quarter buybacks. The insurance side of the business also looked better. Operating margin improved from 6.2% to 6.6%. A big part of that came from pricing changes and a more disciplined strategy. Basically, UnitedHealth is choosing profitability over just trying to grow membership at any cost. Membership did fall by about 1.1 million because the company pulled back from some unprofitable Medicare Advantage markets. Now, losing members usually sounds bad. But in this case, it actually makes sense. UnitedHealth is walking away from business that was not profitable enough. That is probably the right move if the goal is to protect margins and keep earnings on track. Then there is Optum. Optum RX was stable. Optum Insight stayed very profitable, but Optum Health is still dealing with pressure from value-based care contracts. That matters because UnitedHealth is not valued like a simple health insurer. Investors pay a premium because the company has this bigger vertically integrated healthcare model. It has insurance, pharmacy benefits, data, care delivery, and healthcare services all under one roof. When that model works, UnitedHealth deserves a premium valuation. Another positive is that Medicare Advantage risk has eased. The 2027 CMS rate notice came in better than many investors feared. That gives UnitedHealth better revenue visibility and removes one of the biggest concerns hanging over the stock. Trump RX also looks less disruptive than some people originally thought. Since it is more of a cash pay platform, it does not directly plug into employer-sponsored insurance plans or Medicare Part D. So for now, it does not look like a major threat to UnitedHealth's core business, but there are still real risks here. The biggest one is the Department of Justice investigation. Any serious challenge to UnitedHealth's integrated business model could become a major issue. PBM reform is another risk. If new transparency rules put pressure on pharmacy benefit managers, that could hurt Optum RX's long-term profit potential. And, of course, investors still need to watch medical costs, margins, slower revenue growth, and general market volatility. So where does that leave the stock? UnitedHealth's valuation has moved higher after the rally, but it still does not look crazy when you consider the company's size, profitability, cash flow, and defensive position in healthcare. Yes, it trades at a premium to peers, but that premium is not random. UnitedHealth has a stronger business model than most competitors, and it has historically had strong long-term earnings power. The main point is this. UnitedHealth still looks like a quality long-term healthcare stock, but The easy money from the rebound may already be behind us. The company is executing better, it is buying back stock, margins are improving, and the Medicare Advantage outlook looks better than it did a few months ago. To me, Berkshire's exit, regulatory risk, and margin uncertainty should keep everyone's expectations realistic. So here is my case for UnitedHealth. They are still a buy, but the upside from here is probably going to be more gradual. UnitedHealth has to keep proving that its integrated model works, that margins can recover, and that the company still deserves its premium valuation. If you enjoyed this video, make sure to like and subscribe and check out my other stock related videos. Until next time, goodbye.